Okay, we'll start. Okay, as far as what we've completed till now, leaving advanced variances. Suppose we complete advanced variance also. We have one more very important chapter. Another set. Other than this, we are mostly completed our portions. Others and all, we'll just go through everything. How confident are you feeling about what we've already completed? Out of 20, out of 20 or out of 100, whatever we completed, they ask for exam. How confident do you feel about it? Out of 100, you can tell 99, 0, whatever it is. 70, 60, 60, 65. I mean, what happened to other 30? Where are you losing confidence in other 30 or 40? Okay. Check the answer. After checking the answer, I will be able to do it. That is what is required. No one, even if I had opened the book 1 year back, I would also not be able to answer all questions. I am able to be in this position because I've answered all questions and I know. I've answered all questions. I've seen all types of questions. So I know. If you ask me now, I can't tell 100. Or some questions might be new to me also. I can tell 95. So that comes with practice. You have to see questions. Again and again, keep seeing questions. What about the other 40%?
So like I said, practicing from the study of I was going to new concepts. The book is totally very basic. I can see it very hard. So once I see the answer, I can able to do this. Keep on learning new concepts. So I've done it there. I will remember every concept. Like whenever I see the exams itself,
exam kit and study text will be totally different. Exam kit will definitely be complicated. At the end of the day, the thing is, you have to practice more and more. We will follow our concept. One study text, we will be 100% thorough. 100% thorough. Remember each and every line, including the names also if possible. Other study text and other questions, don't try to remember anything. Just go through it again and again. Whenever it is, go through the questions. But one study text, that is Kaplan, you have to be 100% thorough. You have to be in fingertips. If it is this question name, how we will do from starting, you should be able to tell. This is what we will be following for this. Okay. Now we've completed 4 variances. What are the 4 variances we completed? Don't see the book. Close your books and tell. Close your books for something. Books are not required. Close your books. What are the first variance? Material. What are 2 variants and a material variance? Price and material use price and usage variance. Under material price variance, what is the formula for material price variance? Minus actual price into actual quantity. Why actual quantity? What is the mantra we saw? AQSP. AQSP is the mantra we saw. AQSP. Wow, okay. What is the other mantra we saw? Standard hours or standard quantity is given. It's standard hours or standard quantity for actual output. Okay. What is material usage variance? Quantity minus actual quantity into standard price. More revision is required. I can see that no one is revised properly. This one should be in fingertips. Always cost, if you're doing something variance, it always be standard minus actual. Sales, you're doing that, it will be actual minus standard. That's the only difference. Labor variance. What are the 2 variants under labor variance? Labor rate variance, labor efficiency variance. There it is price, here it is rate. There it is usage, here it is efficiency. What is labor rate variance? Standard rate minus actual rate into actual hours. What is labor efficiency variance? Hours minus actual hours into standard rate. What is variable overhead variance? Variable overhead rate variance, variable overhead expenditure variance, variable overhead. Tell. Expenditure variance and variable overhead efficiency variance. What will come under variable expenditure variance? Minus actual rate into actual hours. What is variable expenditure variance? The actual hours into standard rate. AQSP. Standard rate means rate of price means standard. Hours or quantity means actual. Outside. What is sales variance? What are the 2 variants under sales variance? Hmm.
sales volume.
What sales price variance?
Actual price minus standard
Price into
quantity.
actual quantity. Next, sales
Sales volume variance.
volume variance.
Actual quantity minus standard quantity.
Actual quantity minus
Budgeted
budgeted quantity. For sales, we'll have budgeted quantity. We'll not have a standard, we have to sell this. We'll not have something like that. For sales, we'll always budget how much quantity to sell. Actual quantity minus budgeted quantity into
margin.
standard margin. If marginal cost means what is the marginal standard margin?
What's the margin?
Marginal costing means what is the standard contribution. If it is absorption costing means standard profit. Understood all of you. Now we will do fixed overhead variance. Fixed overhead variance again classified into two variances. Fixed overhead expenditure variance, fixed overhead volume variance. Tell what are two variants under fixed overhead variance? Fixed overhead expenditure variance. Tell fully. Fixed overhead expenditure variance, fixed overhead volume variance. Fixed overhead expenditure variance, nothing. How much we budgeted minus what was the actual. Fixed overhead expenditure variance is how much we budgeted by minus how much is actual. Tell what is fixed overhead expenditure variance? How much we budgeted fixed overhead is actual fixed overhead. When I budgeted the rent to be something, actual fixed overhead came out to be something. Huh? No standard, nothing. No standard. Budgeted fixed overhead. Earlier we had budgeted fixed overhead to be something. Minus actual fixed overhead will be something. What is budgeted? How do you find budgeted fixed overhead? How will you find actual fixed overhead? I will teach you while doing the question. But for now, fixed overhead expenditure variance, just remember one thing. Budgeted fixed overheads minus actual fixed overheads. Understood? Tell all of you what is the two variances under fixed overhead variance? But fixed overhead expenditure variance, fixed overhead volume variance. Fixed overhead expenditure variance, what is the formula? Budgeted fixed overhead minus actual fixed overhead. Fixed overhead volume variance, we'll see the formula later, but that will be classified into two. Fixed overhead volume variance will be classified into two. Under variable overheads, what under variance we had? Expenditure and efficiency. Here we have expenditure and volume. That volume is classified into two, being fixed overheads capacity variance and fixed overheads efficiency variance. Fixed overhead volume is classified into saying fixed overheads, repeat, fixed overheads capacity variance and fixed overheads efficiency. Tell all of you what are the two variants under fixed overhead variance? Fixed overhead efficiency, fixed overhead expenditure, fixed overhead volume variance. Fixed overhead volume variance is classified into what and all? Fixed overhead capacity and fixed overhead efficiency variance. Fixed overhead efficiency variance is same as variable overhead efficiency variance. What is variable overhead efficiency variance formula? Variable overhead efficiency variance, what is the formula? Minus actual hours into standard rate. Fixed overhead efficiency variance is standard hours minus actual hours into standard rate. Always outside, if it's rate or price, it will be standard AQSP. Standard price or standard rate. Quantity or hours means actual. So standard hours means actual hours into standard rate. So you know, now we have to know two formulas. We know what is fixed overhead expenditure variance. We know what is fixed overhead efficiency variance. Now we have to know the formula for fixed overhead volume variance and fixed overhead capacity variance. Capacity, I'll tell very logically to remember. Volume is we have a formula. Combine these two formulas, we'll get the volume formula. That's why I'll teach you the volume formula. If you combine these two formulas, we'll get the volume formula. I'll come to that later. But first, we'll know what is capacity variance. You tell me, earlier, I'm taking a place on rent. I thought the place rent is 50,000 rupees. Place rent is how much? 50,000 rupees. Earlier, I thought in this place, 50,000 rupees, I can produce 100 units. How many units can I produce? So paying 50,000 rupees rent, I can produce 100 units. So the 50,000 rupees rent is what? My budgeted fixed cost. Divided by I'm planning to produce 100 units. So how much will be allocated to every unit? How much of the fixed overheads will be allocated to every unit? 500. 50,000 divided by 100, you will get 500. So 100 units is there. Every unit will get 100 rupees of, every unit will get 500 rupees of fixed cost. And 500 rupees of rent will be allocated to every unit. Now suddenly I produced more units than capacity. My capacity I thought is only 100 units. But I was able to produce 200 units. The capacity is how much? 100 units. I thought I will produce 100 units. But I actually produced 200 units. Is it good or bad for me? Good. It is good for me. So now how much fixed overhead is allocated to every unit? 250. Earlier 500 rupees fixed overhead allocated every unit. Now only 250 rupees of the fixed overhead is allocated every unit. With this place, I am able to produce more now. The rent is divided between all the products less. Earlier, each product used to get allocated a rent of 500 rupees. Now each product will get the rent of 250 rupees. So is it good if I produce more units or less units? Suppose fixed overhead is allocated based on hours. Listen very carefully. Fixed overhead is allocated based on hours. My rent is how much? 50,000 rupees. I am producing 100 units. I am producing how much? 100 units. Per unit, I need 2 hours. Totally I am expecting to produce 100 units. Per unit, I need 2 hours. I am expecting to produce how much? 100 units. Each unit I am expecting to take 2 hours. So total how many hours is that? 200 hours. So now if I ask you to find fixed overhead absorption rate, what you will do? Divided by 200 hours. Normally it will be based on hours only. Fixed overhead divided by 50,000 divided by 200 hours, you will get 250 per hour. 250 per hour. So we will get 250 per hour. Per unit how much you will get? 250 into 500. Same way, now I am producing 200 units. 2 per hour. 2 hours per unit. Now tell me, total how many hours I will take? 400 hours. So 50,000 divided by 400 hours, I will get 125 into 2, 125 per hour. Into 2 means I will get 250 per unit. Understood all of you? So now tell me if it's better if it's more hours or less hours. Think and tell. I mean more units means more hours. I wanted more or less. More units means more hours, less units means less hours. I want to produce more units or less units. Whatever it is, generally in a company, it's better for me to produce more units or less units. More only, because if I produce more units, my fixed overheads can be allocated to every units. That is why in fixed overheads, normally in all cost variance, if you see, you will do standard quantity minus actual quantity or actual standard hours minus actual hours. In fixed overheads, capacity variance. If I able to produce more than my capacity, it is good. So only in fixed overheads capacity variance, you will do actual hours minus budgeted hours. Normally all expenditure variance you will do standard minus actual, but here we will do actual minus standard, but not standard budgeted. Fixed overheads will budget initially, no. So actual hours minus budgeted hours into what rate? Into what rate? Standard rate. Always the rate will either be standard or actual only. Remember this. You see now, you open any variance formula and see. Sales variance also we had standard margin. Never will have budgeted margin or budgeted rate or budgeted price. Always standard rate or actual rate only you will have. Whereas hours only you will have either budgeted or standard or actual. For sales, which variance we took actual budgeted quantity? Volume variance. Sales volume variance we took actual quantity minus budgeted quantity standard margin, no. And again for fixed overheads capacity variance we will take actual hours minus close your book. Actual hours minus budgeted hours into standard. Understood? Why we are putting actual minus budgeted? Understood? Now capacity, if you go more than the capacity, it's good. If you go more than the capacity, it is good for a company. So that is why you are doing actual hours minus budgeted hours into standard rate. Understood all of you? So now tell me, what is fixed overhead expenditure variance? Fixed overhead expenditure variance. Always cost don't start with actual. I told you 1,000 times. Cost is don't start with actual. Budgeted fixed overheads, not hours and all. Total we took. We didn't see any formula there. Budgeted fixed overheads minus actual fixed overheads. So budgeted fixed cost and actual fixed cost. That is fixed overhead expenditure variance. Next, what is this side? Fixed overheads volume variance. Fixed overheads volume variance is classified into two. What and all? Fixed overheads capacity variance and fixed overheads efficiency variance. Fixed overheads efficiency variance, what is the formula? 1,000 times I told you, for cost always it will be standard minus actual only. Fixed overheads efficiency variance will copy paste from Variable overhead efficiency variance. What is variable efficiency variance?
Standard
Hours minus actual hours into standard rate. Price will never come here. Fixed overhead capacity variance, what and all will be there? Actual fixed overhead. Capacity variance. Actual hours. Quantity will not come. Quantity will only come for material and sales. Is hours. Actual hours minus budgeted hours into standard rate. Understood? Now, what is the formula for capacity variance? Again, you tell me. Actual hours minus budgeted hours into standard rate. Here, efficiency variance.
Standard hours minus actual hours
Into standard rate. Here we have standard hours minus actual hours into standard rate. This actual and this actual will get cancelled. The actual minus budgeted, the standard minus actual. So this actual and this actual will get cancelled now. We will be left with standard hours minus budgeted hours into standard rate. This actual and this actual will get cancelled when you take it both together. We will have standard hours minus budgeted hours. So that will be the formula for fixed overhead volume variance. Standard hours minus budgeted hours into standard rate. Understood? I will give you 10 minutes time, which I shouldn't supposed to be giving you. This analysis you should revise and come. Super you revised. This analysis basic things you have to know. Whether you do new questions or not, but without revising, don't even think of coming to class. Don't even think of coming to class. If I taught half an hour portion to 1 hour portion, I would have closed today's class and I left you. We didn't do anything. That is why I am continuing today's class. The revision you did, if I had completed some other portions today, I would have closed today's class and left you. I will not take any more class today. Without revision, I will not take class only. No purpose for you or no purpose, I will not waste time. This and all you should revise and come. You should be in fingertips. Whatever we studied, you should revise thoroughly and come. How many days we had? When did we have a last class? How many days leave you had? 3 days leave you had. 3 days leave you had. You could have happily solved, revised everything. You should have been fingertips. Basic formula only you are forgetting. No problem. You came to today's class. This will be the last class. I am again telling you. Next class, if I see any part of it not being revised or anything which I told, which you didn't complete and come, I will close that class as it is. Even if you have taken the class for 5 minutes, even if you come from far away, I will not worry about it. I will close the class as it is. I will tell you to go. I want you to revise. Without revision and all, I will not proceed only. Understood? Without revision, it is a waste of time for you, waste of time for me. You will forget everything. Again, 1 week you break where you are going. After 1 week break, you will not remember anything. So before going to break, my target is this Friday we will not have class. So Saturday going for break on Saturday. We will have only class today, tomorrow, and day after tomorrow. We will have 7 to 1 class. But these 3 days, what I want to do is, whatever we studied till now, I want you to be in fingertips. These 3 days, please don't focus on the other courses. These 3 days, I want you to fully allocate for this. I want you to be 100% thorough on this. Now, before coming back, 1 week at leave you are taking. Now, when you come back, you'll forget everything. So that shouldn't happen. So this 3 days, I want us to thorough everything. What I studied. I want to finish Advanced Variances chapter. I want to finish one more chapter. Plus, I want you to be thorough whatever you completed till now. So please revise and come. Now I will give you 10 minutes time. I will not proceed without that. I will give you 10 minutes time. Please, not 10 minutes too much for this. I will give you 5 minutes time. Material, labor, sales, variable overhead, fixed overhead variance. Whatever you completed till now. Be in fingertips, then only I will proceed. Do it fast, then we can proceed. Okay. And also fixed overhead variance are. So fixed overheads is classified into what and all? So that's expenditure, fixed overhead, volume variance. Fixed overhead expenditure variance is what? Budgeted fixed overhead minus actual fixed overhead. Fixed overhead volume variance is what? It's classified into capacity variance and efficiency variance. Capacity variance is what? Hours minus budget hours into standard rate. Efficiency hours minus actual hours into standard rate. How do you find volume variance? Actual get cancelled, what will be pending? Standard hours minus budget hours into standard rate. This is what is fixed overhead variance. One thing is, under marginal costing, you will generally not take fixed overhead. So variance also, you will not take fixed overhead variance. Under marginal costing, where is when, sir, I will tell you. But under marginal costing, variance also we will not take fixed storage variance. Normally, we will prepare one statement, okay. What statement we will prepare is, we will start with budgeted contribution. So we'll leave marginal costing. We'll come to absorption costing. What we will do is, what our objective in this advanced variance chapter is, we have to start with budgeted profit. We have budgeted some profit initially, no. Based on budgeted cost, budgeted sales, budgeted everything. We'll have a budgeted profit. From that budgeted profit, we have got on actual profit, no. The difference will be what? All variances. The difference between budgeted profit and actual profit will be all variances. Everything. Because of material, my price might increase. Because of profit will get affected. Because of labor, my price might decrease. Because the profit will increase. So whatever happens, I will go from actual profit. So budgeted profit, I should go to actual profit. What will be the reason for all the differences? Variance. All variances. Material variance, sales variance, price, labor variance, variable over variance, and fixed storage variance. All variances together, I will get my actual profit. This is what I will do in absorption costing method. Marginal costing method, what my objective is, I will start with budgeted contribution. And I have actual contribution. The difference will be what? Variance. All variance except fixed storage variance. And contribution, why will there be fixed storage? So I will start in marginal costing method. I will start with budgeted contribution. I will take all variances. All variances I see in the question I will take. And I will end with actual contribution. But in marginal costing also we find fixed overheads. No? After you find the contribution, what you will do? Minus fixed overheads, you will get profit. So at that point, once you find the actual contribution, you start with budgeted contribution, you take all the variances, you find actual contribution. Once you find actual contribution, you will reduce the fixed overheads. No? To actual contribution, you have to reduce what fixed overheads? Actual contribution, you have to reduce actual fixed overheads. To actual contribution, I will reduce actual fixed overheads, I will get actual profit. No. But actual fixed storage will not be given in the question. In the question they will give budgeted fixed storage. So in budgeted fixed storage, what you have to do is, you have to take account for, in budgeted fixed storage, you have to take account for fixed storage expenditure variance. You tell me, your budgeted fixed storage, how will you find actual fixed storage? We'll use that formula. What is fixed storage expenditure variance? Fixed storage expenditure variance is equal to budgeted fixed storage minus actual fixed storage. What do we want? Actual fixed storage. So actual fixed storage is equal to budgeted fixed storage minus fixed storage expenditure variance.
Yes, sir.
Understood? So we'll do that. We'll find actual fixed storage and then we'll reduce actual fixed storage. We'll get actual profit. So absorption costing method is what you will do. You will start with. You start with budgeted profit. You will take all possible variances. You will get done. For marginal costing method, what you will do? Budgeted contribution, all variance except fixed overhead variance, you will get actual contribution. To that you have to reduce actual fixed overhead, you will get actual profit. To find actual fixed overhead, what you should do? Budgeted fixed overheads minus fixed overhead expenditure variance from the variance. Understood? This is what we will do now. That is called as operating statement. We will prepare something called as an operating statement. Before proceeding to that, come to test and question number 5. One question I will do, other questions you will do. Okay. Come to test and question number 5. This question I will do. So we will see what and all is given to us. First, the following information for J Limited for period 4 is given to us. What are given to us? What is the first number? Budgeted fixed overheads is given to us, super. Budgeted units is given to us, super. Standard time to produce each unit is given to us, super. Next, actual fixed overheads is given to us, actual units is given to us, labor hours is given to us, actual labor hours is given to us. Understood? Yes, sir. What are they asking? If J Limited uses an absorption costing system, calculate the following. I told you, only for absorption costing, we'll have all the variances. For marginal costing, what variance you will have? But to find actual fixed overheads, what variance you will take? Minus fixed overhead expenditure variance. So for marginal costing system, we will take only fixed overhead expenditure variance. If you take fixed overhead expenditure variance, you will get actual fixed overhead. No. So for marginal costing method, you will take only fixed overhead expenditure variance. For absorption costing, you will take all fixed overhead variance. Understood? One they are asking. What is the first one they are asking? What is FOIR?
Fixed overhead absorption.
How will you find fixed overhead absorption rate? How will you find fixed overhead absorption rate? Fixed overhead absorption rate, read the question clearly. Per labor hour they are asking. How will you find? Divided by labor hours. What labor hours? Actual labor hours or budgeted labor hours? Normally absorption costing method you will use, no, fine, no. Look at me, all of you. Normally absorption costing, what you will do? You will take budgeted fixed hours by budgeted hours. Based on that, you will find the fixed hours absorption rate initially. It will increase or decrease, that is later. But based on that, you will find no. So, what is budgeted fixed overheads? 22,960. Okay, they are asking fixed overhead absorption rate per labor hour divided by what is budgeted labor hours? So, budgeted units is 6560. Standard time to produce each unit is 2 hours. So, what is budgeted labor hour? Budgeted fixed labor hours? 26560 into 2 hours, you will get 13,120 hours. So, how much you will get? 22,960 divided by 13,120. 1.75, yeah. 1.75 per hour. So, fixed overhead absorption rate is 1.75 per hour. Understood, all of you? Fixed overhead absorption rate will always be found using budgeted fixed overhead divided by budgeted hours. Budgeted hours, how did you find? You derive the formula for budgeted hours. You derive the formula for budgeted hours and tell me what is the formula for budgeted hours? Budgeted units into hour per unit. You derive budgeted units into standard hour. Budgeted units into standard hours per unit. If you do that, you will get budgeted hours. Understood? How will you find standard hours? Not this, leave this question. Generally, they ask for standard hours. How will you find standard hours? Don't look at me like that. Don't look at me like that. How will you find standard hours? Don't look at the book. Nothing that look at the book. Generally, how will you find standard hours? Standard hours for actual output. What are you thinking? I mean, what you are thinking? This is basic. How will you find standard hours? Standard hours for actual output. That is the second mantra we saw. That is something we should not forget for life. Mantras are something we should not forget for life. How will you find budgeted hours? Budgeted units into budgeted units for standard hours. Standard hours for budgeted unit to standard hours. Two things. If they ask for standard hours, how will you find? Standard hours for actual output. If they ask budgeted hours, how will you find? Budgeted units into standard hours. There you will do actual units into standard hours. Here we will do budgeted units into standard hours. Understood? So something we have to learn through the process. Okay, next. Understood fixed overhead absorption rate, all of you?
Yes, sir.
Okay. Now, fixed overhead expenditure variance they are asking. What is the formula for fixed overhead expenditure variance? Fixed overheads minus actual fixed overheads. What is budgeted fixed overheads? 22,960 minus what is actual fixed overheads? 24,200. What you are getting? Adverse. Negative you are getting how much? 1,240 adverse you are getting. So fixed overhead expenditure variance is adverse. Why is it adverse, sir? My budget or my fixed overheads to be 22,960. My actual fixed overheads came up to 24,200, came more. So it's an adverse variance. Understood, all of you? There's one more way in which you can find fixed overheads expenditure variance. What is fixed overheads expenditure variance formula? Budgeted fixed overheads. Budgeted fixed overheads is nothing but budgeted hours into standard rate. There's nothing called budgeted rate. How will you find the rate? How will you find the amount? Hours into rate, you will find the amount. So budgeted expenditure is nothing but budgeted hours into standard rate. Actual fixed overheads is actual hours into actual rate. Understood? Budgeted fixed overheads is nothing but budgeted hours into standard rate. You don't have to write anything. I've sent Excel in the group, which I'll be uploading the link also. Everything is there. Entire advanced variance, formula, everything is there properly. What is budgeted fixed? What is fixed overhead expenditure variance? Fixed overheads minus actual fixed overheads. What is budgeted fixed overheads? If they did not given the question, how you can find? Budgeted hours into standard rate. Standard rate per hour per unit hour. Per hour. When you are multiplying hours, you have to multiply standard per hour only. So lace chips you are buying. Lace chips, number of lace chips into price of lace chips per packet. You will do that or you will do number of lace chips into number of hours you will do. Price per hour you will do. If you're comparing units, you'll multiply by units. If you're comparing hours, you multiply by hours. So budgeted hours into standard rate per hour. What is the actual fixed overhead formula? Actual hours into actual rate per hour. Understood? What is fixed overhead expenditure variance formula? Fixed overhead minus actual fixed overhead. Understood? So two variances done. Come to third question. Fixed overhead capacity. If you see in the question only they've given, beautifully they've given fixed overhead volume variance is given in the last. What is the reason? What is the reason? Why have they given fixed overhead volume variance in the last? Exactly. It's not that we need that. They are saying first you find the capacity, then you find efficiency, then you add both, you'll automatically get the answer. Understood? So what is fixed overhead capacity variance? Capacity is what you have to remember. Actual should be more. Budget should be more. Actual should be more. Actual should be more. What is the actual? What is the formula for fixed overhead capacity variance? Minus actual hours minus standard hours into standard rate. Actually, standard hours. Actual hours minus budgeted hours. Actual hours minus budgeted hours into standard rate. Okay, what is the actual hours given to us? See clearly. What is the actual hours given to us? 12,600 is actual labor hours. Actual labor hours is 12,600 minus what is budgeted hours? How do you find budgeted hours? First, how will it find budgeted hours? Tell me that. Budgeted units into standard hour per unit. What is budgeted units? So, into what is standard hours per unit? 2. 6560 into 2 is 13,120. So, 12,600 minus 13,120 into what is standard rate? What is standard rate? Is it standard rate per hour or standard rate per unit? First, tell me that.
Standard rate
Per hour or standard rate per unit? Standard rate per hour. Because we have hours inside, we have multiplied standard rate per hour. How will you find standard rate per hour? Sir, we found out earlier, no, fixed overhead absorption rate, we found out, no. How did you find that out? Budgeted fixed overhead divided by budgeted hours. Budgeted hours, not budgeted hours, standard hours. When you do that, you got 1.75 per hour, no. That is your standard rate. Standard rate, that's why I told you, that is 1.75 per hour. That what you found out is 1.75 per hour. So, into 1.75. Understood? Actual hours, again tell me, what is fixed overhead capacity variance formula? Actual hours minus budgeted hours into standard rate. What is actual hours? Given the question, what is budgeted hours? How will you find budgeted hours? Units into standard hour per unit. How will you find, if they ask in the question standard hours, how will you find standard hours? Standard hours. Standard hours for actual output. Okay, so leave that for now. Into standard rate, you have to take the standard rate per hour. Standard rate per hour is what we found out earlier. You have to take the budgeted fixed overheads divided by budgeted units into standard hours. If you take, you will get the budgeted fixed overheads divided by budgeted hours. You will get the standard rate per hour. Understood? Standard rate per hour. Multiply by that, you will get the answer into 1.75. If you do 12,600 minus 12,600 minus 13,120, what you will get? 12,600 minus 13,120, 520 hours negative into 1.75. If you put how much you will get? 910. Adverse is your fixed overheads capacity variance. Now fixed overheads efficiency variance. What is the formula? Copy paste from variable overhead. What is the formula? Actual hours into standard rate. Super. What is standard hours? How will you find standard hours? Standard hours for actual output. So actual output is 6460 into standard hours per unit is 2 hours. 12,600 into 2, how much you will get? 6460. 6460 into 2, you will get 12,920. Minus what is the actual hours? Some random number you tell. What are the actual hours? 12,000. Actual hours is 12,600. Actual hours is how much? 12,600 into what is standard rate per hour? 1.7. We just found out how much you are getting. 12,920 minus 560. 560 favorable variance we got. Now what is fixed overage volume variance?
Standard half.
Technically we can add both and we'll get the answer. Fixed overage volume variance, if you add both, that is 910 adverse and 560 favorable. You add both and see 910 adverse and 560 favorable. Minus 350 R. So 350 adverse is your fixed overage volume variance. This is one way. Second way is use our formula. What is the formula for fixed overage volume variance? Standard hours minus into standard rate. What is standard hours? We found out 12,920 minus budgeted hours. That also we found out 13,120 into 1.75. How much are you getting? 350. You should get 350. No way you will get another answer. Understood? This is how fixed overage variance should be approached. Now tell me, one we'll break through. Close your books for 2 minutes. Just close your books for 2 minutes. We'll just try to recall every formula. Standard rate per hour. Understood? Now, one by one we'll see. Fixed overage variance classified into what and all? Expenditure variance and volume variance. Please repeat after me. What are the two variances? Expenditure variance and volume variance. Fixed overage expenditure variance. What is the formula? Budgeted fixed overage minus actual fixed. How will you find budgeted fixed overage? Into budgeted units into. If you do that, what you will get? You get the budgeted hours you will get. Budgeted hours you will get, not budgeted fixed overage. Budgeted fixed overage mostly given the question. If you take number of units, budgeted units into standard hours per unit, if you do, you will get the budgeted hours. You get the budgeted hours, not budgeted fixed overage. Budgeted fixed overage will be given the question. Minus actual fixed overage. What is the formula? First, you will find actual hours. Actual hours will be given in the question. If they don't give in the question, you find actual units into actual this thing, you will get actual hours. Actual hours into actual rate, you will get the actual fixed overage. Budgeted fixed overage will be given in the question. Minus actual fixed overage, if you do, you will get the fixed overage expenditure variance. How will you find fixed overage absorption rate? Fixed overage divided by budgeted hours. Budgeted hours. Budgeted fixed overage divided by budgeted hours. How will you find budgeted fixed overage? Will be given in the question. Divided by budgeted hours, how will you find? Units into standard hours per unit. You get the budgeted hours. Budgeted fixed overage divided by budgeted hours, you will get the fixed overage absorption rate. That rate per hour you will get no. That you will take it as standard rate per hour. That fixed overage absorption rate per hour which you get, that you can take as a standard rate per hour. Understand? That is one thing we have to see. Second, what is fixed overage capacity variance? Actual hours minus budgeted hours into standard rate. Actual hours and budgeted hours will be given. We found out earlier, no problem. What is fixed overage efficiency variance? Standard hours minus actual hours into standard rate. Standard hours you can come. This formula you can copy paste from variable overhead efficiency variance. What is standard hours? How will you find standard hours? Hours for actual output. Actual output into standard hours per output. If you do, you get the standard hours for actual output. Minus actual hours, you will get this thing. How will you find volume variance? Addition of both these variances will get volume variance, or you can use the formula of actual hours and actual hours will cancel, so you'll be left with standard hours minus budgeted hours into standard rate. If you do this, you will get the fixed overhead volume variance. Understood? This is how a question can be asked. More than nothing can be asked. More than this, in fixed overhead variance, nothing can be asked. No fixed overhead question can be asked. Now come below. Do we have another question on fixed overhead? No, we don't have, but we'll have many upcoming questions. But understood fixed overhead variance, understood all of you. I will give you 2 minutes time or 5 minutes time without seeing not even one single formula. Try to do question number 5. After that, if you have any doubts, ask me.
Sir, I have a doubt.
Yes.
That fixed budgeted fixed overhead we used to derive using budgeted units into what standard rates.
Budgeted fixed overheads. Budgeted fixed overhead is asking. Budgeted fixed overhead will be given in the question.
Directly.
Given the question. But what we found out budgeted hours. Why we found out budgeted hours for the next formula?
Yes, sir.
To find budgeted hours, we need to take budgeted units into standard hours per unit. That is for next formula.
Okay.
Actual hours minus budgeted hours we are doing. For that we need. But for fixed overhead, the expenditure variance formula budgeted fixed overhead minus actual fixed overhead. That budgeted fixed overhead will be given in the question.
Okay.
Don't worry about it.
Okay, sir.
Budgeted fixed overhead will be given in the question.
Okay. What about the actual fixed overhead?
Actual fixed overhead, actual hours and actual rate. Budgeted fixed overhead also budgeted hours and actual rate. What's a budgeted hours and budgeted rate? Standard rate. What?
This question
Mostly they give the actual fixed overheads only. No. Mostly budgeted fixed overheads and actual fixed overheads will be given in the question. In case if it is not given, what you should do is budgeted hours into standard rate. There's something called as budgeted rate. Standard rate per hour. Standard rate is OAR, exactly.
They will give
Anyone. So this you can do. Actual fixed overhead, this is not given in the question. You can again take actual hours into actual rate per hour. Budgeted hours, budgeted fixed overhead, how you can do budgeted hours into standard rate per hour. Again tell budgeted fixed overhead, how you can find budgeted hours into standard rate per hour. What is the standard rate per hour? OAR, fixed overhead above absorption rate. Actual fixed overhead, how we can find actual hours into actual rate per hour. But the problem is budgeted hours into standard rate per hour you are doing now. That budgeted hours we have to find out. How will you find budgeted hours? Budgeted units into standard hours per unit. Understood? Don't worry about anything. Now first do question number 5. Open the Excel file I gave you. After that, not now. Open the Excel file I gave you. You go through that, everything is written clearly. But not now. That has more formulas which you have to cover in the upcoming class. That you will know. But for now, you do question number 5. Take 5 minutes time, do question number 5, and then we can proceed to the next very easy concept. After this, no confusion. Fixed overheads will only be confusing. It will also not be confusing next 2 minutes. It will be very easy. After that, we will proceed to next concept. Do it fast. Do test and understanding question number 5. Then we can proceed to the next concept. Okay. Okay, can you proceed? What we will do the operating statement once and try to go through the format once. Then we will go through the test and understanding question of 6 faster. I will just revise it fast. Okay. First, operating statement. Under absorption costing operating statement, what is our objective? Actual profit. From budgeted profit, we have to go to actual profit. What will be the differences? All variance. Under absorption costing, all variances. So first we will start with budgeted profit, then we will take first what variance? Sales volume, profit variance. As with absorption costing, we call it sales volume, profit variance. Because marginal costing, what will we call it? Sales volume, contribution variance. Okay, so sales volume, profit variance we take here, then we will get standard profit on actual sales. Then from that we will take all other variances. What other variances? Selling price variance, material price, material usage, labor rate, labor efficiency, variable load expenditure, variable load efficiency variance, fixed overhead expenditure variance, fixed overhead capacity, and fixed overhead expenditure. All variance you take, you will get actual profit. This actual profit you get from here. Compare the what actual profit you got. If it's both the same, their answer is right. That is our ultimate objective in this operating statement under absorption costing. But one thing you have to be very careful is if it is a favorable variance, what you have to do? Add. So favorable variance will add your actual profit. Will increase your actual profit. We will add. If it's adverse variance, we will subtract. These 2 things you have to know. Operating statement under marginal costing, same thing. But there, what we have to do? We have to start from budgeted contribution and arrive at actual contribution. That is the first objective. We have to start at budgeted contribution and arrive at actual contribution. Okay. Not only we should take all variance, but one small change will be there. What we will take? Sales volume, contribution variance we will take. If we take that, we will get standard contribution on actual sales. From that, you have to take all other variances: sales price, material usage, labor rate, labor efficiency, variable expenditure, variable efficiency. No fixed overhead variance will come. So if you take all the variance except fixed overhead variance, you will get what? Actual contribution. From budgeted contribution, arrive at actual contribution. From actual contribution, you have to reduce actual fixed overheads to arrive at actual profit. From actual contribution, you have to reduce actual fixed overheads to arrive at actual profit. But actual fixed overheads will not be given in the question. Only budgeted fixed overheads will be given in the question. How will you arrive at budgeted fixed overheads minus that variance? That only one variance. Budgeted fixed overheads minus fixed overheads expenditure variance. No other variance you will take. Only budgeted or only fixed overheads expenditure variance. Why did we arrive at this formula? How did we arrive at this formula? Because fixed overhead expenditure variance is equal to budgeted fixed overheads minus actual fixed overheads. From this will take it. This will get here. So actual fixed overheads is equal to budgeted fixed overheads minus fixed overheads expenditure variance. Understood? So, one example, budgeted fixed overheads is 10,000. Fixed overhead expenditure variance is 1,000 adverse. Fixed overhead expenditure is 10,000 Budget of fixed overhead is 6,000, 10,000. Budget of fixed overhead is 10,000. Fixed overhead expenditure variance is 1,000 adverse. Actual, so budgeted fixed overhead to be 10,000. This is 1,000 adverse being negative 1,000. So 10,000 minus of minus 1,000. So 10,000 plus 1,000 you will get 11,000. Logically, if you see 10,000 is budget of fixed overheads. Variance adverse is 1,000. Adverse is 1,000 means it's but actual should be more. That's when you get the actual is more by 1,000. So 11,000 rupees actual fixed. If you do that, you will arrive at the actual profit. These are two statements. So coming to question number 6. Question number 6, what they are asking, they gave everything. First, this is a set of standard or budgeted cost card, and below what is given to us is actuals. So first, what they are asking, you require to reconcile the budgeted profit with the actual profit. What is the actual profit given in the question? 47,320. So what is the budgeted profit given in the question? 37,500. 15. What is 15 rupees? 50 rupees is per unit into 750 units. 50 into 750, 37,500. What is the actual profit? 47,320. So we have to arrive from 37,500 to 47,320. So we have to take all variances which we see. We will start one by one. First, we have direct material A, direct material B. We have direct wages, fixed production overhead. Here we don't have variable overhead variance. We have only material. Two material variance we have, one labor variance we have, one fixed overhead variance we have. Material variance. What are the two material variance we have to find out? Material price variance, material usage variance. Material price variance for AB, material usage variance for AB. We have to find out. First, we will complete A. Material A. What is material price variance formula? Standard price minus actual price into actual quantity. Quantity is coming outside, so actual. So what is standard price? Standard price is 12. What is actual price? 91,500 divided by 7,500 kg. You will get some amount. So, 12.2. Okay. 12 minus 12.2 is 0.2 into actual quantity is how much? If you do that, what you will get? 1,500 adverse negative. Next, material A, usage variance. What is the formula? Minus actual quantity into standard price. For all those price, standard price. What is standard quantity?
Standard quantity for actual output.
Super. Standard quantity is 10 into actual output is 700. 10 into 700 is 7,000 minus
Actual quantity was 7,500.
7,500 into standard price 12 per unit. If you do that, what you will get? 6,000 adverse. Like that, you do for all variances. To do all variances, you will arrive at some amount. You reduce that and this, you will get your actual profit. It should reconcile. If it doesn't reconcile, some mistake you have done on the student exam. Okay, now we will proceed to question number 7. Question number 7. You don't have to do. I will do. You just help me with it. Question number 7. You don't have to do. I will do. You just help me with it. Okay. First, again, what have they given? The following statement. Following standard cost apply for production of 100 cylinders. So the numbers they've given below is for 100 cylinders. Okay. So the monthly production of sales budget is 10,000 cylinders. Understood? The monthly sales budget is 10,000 cylinders. The cost card is given to us for 100 cylinders. In earlier case, what they gave? They gave for 1 unit. Here they gave for 100. It is better or advisable to convert everything to 1. Okay, it's better to convert everything to 1. Starting only, so that it will be very easy for us. Next, selling price per cylinder is given to us and actual is given to us. You require to prepare operating statement in marginal costing format. Marginal costing format means you start from where and end at where? You start with which contribution? Budgeted contribution and end at actual contribution. What is the budgeted contribution in the question? What is budgeted contribution formula?
Sales minus variable cost.
Sorry. Listen to me. It's not budgeted contribution. Now what do you start with? No, you start with which? Operating statement, you start with budgeted contribution or standard contribution? Budgeted contribution. Anything. Here, it doesn't matter. Full headings, it doesn't matter. So, budgeted contribution. What is budgeted contribution?
Sales minus variable.
Sales minus variable cost. What is the sales price per cylinder? Sales price per cylinder is 6. What is variable cost per cylinder?
They gave for 100.
So, find everything for 1. So, material. Per unit, how much kg is required?
400.
For 100 cylinders, 500 kg is required. Means per unit, 500 divided by 100 is 5 kg. 5 kg of material is required at 0.8 per kg. Labor for 100 cylinders 20 hours required, means for 1 cylinder how much is required? 20 by 100. How much?
0.2.
20 by 100, 0.2. Nothing, for 100 cylinders they are given. We are finding for 1 cylinder. So labor for 1 cylinder 0.2 hours at 1.5 per hour. Is there any other variable cost given to us in the question? No other variable cost. So what is the total variable cost?
0.8 plus 1.
Not 0.8. 5 into 0.8. 0.8 is per kg. Per unit, we need 5 kilos. Per unit, we need 5 kilos at 0.8 per kilo. So 5 into 0.8, 4. That is for material. For labor, 0.2 into 1.5. How much will you get? 0.3. So total variable cost is 4.3. Selling price is 6. 6 minus 4.3 is 1.7 is the budgeted contribution. Understood all of you? Yes or no? Into 10 into 10,000 cylinders. If you put, you will get total how much? Into 10,000 cylinders, you will get 17,000 rupees is your budgeted contribution. We have to start from 17,000. We have to end at what? What is the actual contribution given to us in the question? What is sales? 63,000. What is variable cost? Total. How much you produced? Sales is 63,000. Minus what are the variable cost given in the question? Material is a variable cost. Labor is a variable cost. Sales minus material minus labor. What you are getting?
17,400.
How much you are getting?
17,400.
17,400. Exactly. 17,400. Now we have to find all variances in between. First, what variance we can find out? First, we'll start with material variance. Material price variance, material usage variance. Sales variance. First, what is sales? What variance will take? Sales volume variance. What is sales volume variance? Actual quantity
minus budgeted quantity
into what is the actual quantity?
Actual quantity is
10,600. What is budgeted quantity?
10,000.
So, 10,600 minus 10,000 into standard contribution. Standard contribution per unit into 1.7. How much are you getting? 1,020 favorable. Okay, so one small thing I will tell you, the 1.7 you found out now, that is standard contribution only. The 1.7 you found out is standard contribution. Into 10,000 units when you put 20, you will get the budgeted contribution. When it's per unit, 1.7 per unit is a standard contribution. When you multiply by total of budgeted units only, you will get the budgeted contribution. Understood? So the 1.7 is standard contribution. Into 10,000, 17,000 is your budgeted contribution. Understood? So 1020 is sales volume variance. If you do standard contribution minus sales volume variance, what you will get? Standard contribution for actual sales. How much is that? 17,000 minus plus 1020, you will get how much? Don't use calculator. 18,020. Next, what variance you will take? Sales price variance. If you take sales, what is sales price variance formula? Price, standard price into what is the actual price? 63,000 is total selling price divided by 10,600 cylinders. If you put, how much you are getting? 5.94 is your actual price minus standard prices 6 into actual quantity is 10,600 cylinders. If you do, how much you are getting? 636. It will be 600. 600 adverse. I'll tell you one small shortcut. What is the sales price variance?
Sales price.
As I'm finding no. The sales price variance formula. Standard price into actual quantity. So some cases you are getting a situation where you have to find the actual price. No. Without finding the actual price per unit, I'll tell you a shortcut to use. Take the formula inside. So take the brackets, close the brackets. So what will happen? Actual price into actual quantity minus standard price into actual quantity. Actual price into actual quantity is given to us 63,000. Actual price and actual quantity 63,000 is given to us. Minus what is standard price? 6 into actual quantity 10,600 cylinders. Now if you do and tell me how much you are getting, 600 exactly you will get. That adverse Adverse no. 600 negative. So in exam, when you're getting situation like this for dividing, see if you can take it inside and you have the values with you. Understood? You get more exact amount. Understood? No? Understood? No? Okay. Next, what we have to find? Material variance. Material. What are the two variants we will find? Price and usage variance. What is material price variance? Minus standard price minus actual price into actual quantity. What is standard price of material? 0.8 is standard price of material. Minus what is actual price of material? 42,500 divided by. Wait. Before doing that, see if you can take it inside. Write down the formula first. What is the formula? Always before writing a question, formula is mandatory. You have to write. Now you write AQ, SP and all. In exam, you have to write actual quantity. So first write down the formula. What is the formula? Standard price minus actual price into actual quantity. Take it inside and see. If you take it inside, what will happen? Standard price into actual quantity minus actual price into actual quantity. What is standard price? 0.8 into what is actual quantity? We are very, very careful. 0.8 is material quantity. You have to multiply material quantity is 53,200. What is minus actual price and actual quantity directly given to us? No. 42,500. Nothing but actual price and actual quantity. 40 minus 42,500. If you do, how much you are getting? How much? 60 favorable. 60 favorable. That's it. Next exam division is coming. Now put it inside and see if answer is coming. Not in all cases it comes. Some cases if it comes, it comes. If not, just proceed with it. Understood? Next, do this only when you are getting situation where you have to divide two things. When you are getting a situation to divide two things, you try to do this and see if you are getting the answer or not. Understood? Next, what is material price variance? Usage variance. What is material usage variance?
Standard quantity
minus actual quantity into what is standard quantity?
10,000.
Standard quantity.
Standard
0.8 standard quantity for actual output. 0.8 into 0.8 into 0.8 into. First, tell me what is the standard quantity per unit. Per unit, standard quantity is 5. Per unit, standard quantity we need 5 kilos. Per unit, standard quantity we need is 5 kilos. Always when you are getting standard quantity in the question, we will try to answer this. Standard quantity per unit, how much we need? 5 kilos. What is the actual output? 10,600. 5 into 10,600, you will get the standard quantity. How much? 53,000. Minus what is the actual quantity? What is the actual quantity? Talking about material, actual quantity 53,200 is given to us in the question. Into standard price per material is 0.8. Understood? If you do what you are getting? 160 adverse. Amazing. Next, we have two other variants. What is labor variance? Fixed storage variance will not come now. What is the only fixed storage variance we will take for marginal costing? Only fixed storage expenditure variance will take, that we will do later. But now we need to find only labor variance. What are the two labor variants we will find out? Labor rate and labor efficiency. Labor rate variance, what is the formula? Standard rate minus actual rate into hours. What is standard rate?
Standard rate is 1.5.
What is actual rate? You divide R. So take the formula inside. Standard rate into actual hours minus actual rate into actual hours. Standard rate into actual. What is standard rate? 1.5 into 2040 is actual hours. 2040 minus actual hours and actual rate is 3,100. If you do that, what you are getting? 40 adverse. Good. Next, what we have? Labor efficiency variance. What is the formula? Standard hours minus actual hours into standard rate. What is standard hours? Standard hours for actual output per unit. First, what you have to find? What is standard hours per unit? 0.2 into total actual unit is 10,600. 0.2 to 10,600 is 2,120 minus what is actual hours? 2,040 into standard rate per hour 1.5. What is 0? 1.5. What are you getting? 120 favorable. If you add all this, see if you are getting actual contribution. I'll just tell you everything. You just see 17,000 plus 1020 minus 600 plus 60 minus 60 minus 40 plus 120. Getting 17,400.
7,500, sir.
What did you do? 17,000 minus 1 plus 1020 minus 600 plus 60 minus 160 minus 40 plus 120.
So the yes sir. First instead of saying 160.
660. Okay. 71,400 getting on. This is what actual contribution. What do you want? You want actual profit. From actual contribution, you have to reduce actual fixed overheads to get actual profit. The actual fixed overheads given to us on the question.
Yes.
How much? 2,200. If you reduce that, what you will get? 70,400 minus 2,200. Directly they gave. What you will get?
Okay.
70,400 minus 2,200. What you will get? 15,000. But in the question they will tell sometimes. Sometimes in the question they will tell. First find the fixed overhead expenditure variance and then give account to it. They will tell. How will you find fixed overhead expenditure variance? What is fixed overhead expenditure variance? Budgeted fixed overheads minus actual fixed overheads. What is budgeted fixed overheads? Huh?
450, 400.
What is budgeted fixed overheads?
0.2.
What is budgeted fixed overheads?
Budgeted units into
Wait, 20 rupees is what?
400.
0.2 is for one cylinder, 20 is for 100 cylinders, 20 divided by 100, 0.2 is for per cylinder. Into how much cylinders we want? 0.2 into 10,000, you will get 2,000 rupees. The budgeted fixed overheads. What is the actual fixed overheads? 2,200. How much you will get? 200 adverse. This you are finding just so that you will get 2 marks for this. For finding fixed overheads, same thing you are doing only. But to find, if you find this, you will get 2 marks. Fixed overhead expenditure variance. 200 we got. Tell me carefully. What is the actual fixed overhead? What is budgeted fixed overheads?
2,000.
We just found out 2,000. Fixed overhead expenditure variance is how much?
It's adverse.
200 adverse. You have to add or minus.
I had 2,000.
It's adverse. It's adverse.
2,000 bad.
Normally 10,000 is budgeted.
Okay.
Minus expenditure variance you have to put. This is minus of minus. So 10,000 plus 200, 10,200. Sorry. 2,000 minus or minus 200, 2,200 you will get. To take that to fixed actual fixed overhead, you will get your actual profit. Understood?
Yes, sir.
In exam, even if they give directly, don't take directly. Do like this.
Okay.
Same only.
You have to do
But showing that we found out a fixed overhead expenditure variance also we have to find out. That will give 2 marks for this. Understood? This is how a question should be approached. Easy or not? Easy or not? Okay. Now we are going to see. In depth of labor variance. We actually have to see more in depth of material variance. We have to see more in depth of sales variance. That is more in depth, very easy. More in depth and very easy. But we will see some more concepts of labor variance. What are the 2 labor variance you already saw? Labor rate variance, labor efficiency variance. What is labor rate variance? Rate minus actual rate into actual hours. What is labor efficiency variance? Hours minus actual hours into standard rate. What they are saying is, what is in labor efficiency variance, what they are finding out, how efficient the labor is finding out. But they are saying they are not satisfied with that formula because they are saying labor efficiency variance is not only how much he should have worked and how much he worked only we have to compare. Sometimes he is too much sitting in the place now. So that variance they have to split it separately. So labor efficiency variance they are classifying into 2. One is productive efficiency variance. One is idle time variance. That is productively how much is he working, idle time how much is he sitting. This is what we are going to find out. Labor efficiency variance classified into 2. Productive efficiency variance and idle time variance. That's how much hours he worked. With that we are comparing. Understood? I will tell you what to do. First, what is labor rate variance? Minus actual rate into actual hours. We will not pay for all hours. No. We will not pay for all hours. We will pay only for hours he worked. So, if the question is given like this, we will take standard rate minus actual rate into actual hours paid for. How many hours you actually paying him? He would have worked for 10 hours, Suma would have sat for 1 hour, but you actually paid him only for 9 hours. He worked for 10 hours, but Suma is sitting for 1 hour, no. But technically he worked only for 9 hours. For 9 hours only we will pay him. So what is labor rate variance? The new version. Standard rate minus actual rate into actual hours only. But actual hours paid. Actual hours only, but actual hours we actually paid him for. Actual hours work might be more, actual hours paid might be less. or anything, any vice versa also. Understood?
So then what will the standard rate be like?
Standard rate we are paying per hour.
That is what the paper.
No, that is per hour only. No,
Okay.
paid or don't pay doesn't matter. That is per hour only. No. Now we will find idle time variance. Idle time variance, same formula. There is no separate formula for idle time. Idle time variance formula is standard rate minus standard rate. So idle time. Actual hours minus actual hours into standard rate. Idle time variance is actual hours minus actual hours into standard rate. What is tell me? So I'll tell you. Wait. What is idle time variance? Actual hours minus actual hours into standard rate. That is actual hours worked minus actual hours paid for. He would have worked for 10 hours, but he paid him only for 9 hours. That is idle time variance. Actual hours worked minus actual hours paid. If actual hours he worked is 10 hours, we paid him for 9 hours. It is favorable or adverse to us? Favorable. That is, say actual hours worked minus actual hours paid. He worked for 10 hours. We paid him for 12 hours. Is it adverse? That's what defining formula. What is idle time variance? Actual hours worked minus actual hours paid into standard rate per hour. Productive efficient variance is same. What is normal efficiency variance? Actual hours into standard rate. Here also same, standard hours minus actual hours into standard rate. But here we are going to compare only for how much he worked actually. Standard hours minus actual hours worked into standard rate. That is, standard he should have worked for 10 hours. He worked for 9 hours. That is what we will compare here. Efficiency variance will compare how much he worked it.
But here standard hours for
actual output. Minus actual hours worked. For rate variance we took both as paid. Idle time variance we took for
paid
actual hours only, worked and paid. Here also we will take, but standard hours minus actual hours worked. In exam, if you forget, think logically. We'll go one by again. I'll go from below. I'll go productive efficiency variance. What will compare? Standard hours minus actual hours into this style actual hours into standard rate is only what we will take. But here we will compare standard how much he should have worked minus actual hours how much he worked. That is what we have to take. That is productive efficiency variance. Now the labor efficiency variance. So now tell idle time variance. First tell the normal formula. Actual hours minus actual hours into standard rate. Is it better if he works more and pays lesser? It is better if he pays more and works lesser. Works more. So work will come first, pay will come next. So actual hours worked minus actual hours paid. Understood? Into standard rate. What is labor rate variance?
standard rate.
Rate will talk only about payment. Rate will talk only about payment. Standard rate minus actual rate into actual hours. I will talk only about payment. Sorry, take actual work. Labor rate will talk only about payment. How we paid for that only will compare. Understood?
Yes, sir.
Understood? Again tell. We'll go from below. Add these both you will get. Add productive efficiency and idle time variance you will get.
Then what will come, sir? Like the main formula.
And that is not true. You will get confused to see that. Add these both you will get. Understood? Tell again. First we have three formulas. Labor rate. Under labor efficiency we have productive efficiency and idle time. Productive first we will come to productive efficiency. Productive efficiency, what is the formula?
Standard.
Now product efficiency variance, what is the formula? Standard hours minus actual hours into standard rate. Here we will compare standard hours minus actual hours worked. How much he should have worked, how much he worked. Okay, yeah. That's normal standard hours only. Standard hours work like that. Standard hours normal standard hours only. Minus actual hours, how much he should have worked into standard rate. Idle time variance, what you will compare? Normal idle time variance, actual hours minus actual hours into standard rate. What? Worked first or paid first? Worked. Because if we work more and pay less, it is better to us. It is favorable to us. So actual hours worked minus actual hours paid into standard rate. What is labor rate variance?
Standard rate
Minus actual rate into actual hours paid. Because we will talk only about payment. Then understood. Very easy formula. No questions here. We have questions on exam kit that we will do later. This is what I want to tell you. Understood all of you?
Yes.
Any doubts here? Now I'll tell you what to do. First, do question number 7. Question number 7, we've discussed also. I want you to do question number 7 without even seeing one bit. No discussion without even seeing one bit. You do question number 7, then I'll tell you what to do. Do it first. I'll be here only. You do question number 7, then I'll tell you what to do. Any doubts you ask me, please don't discuss within yourself. This one question alone.